Welcome back to smarthelping.com. Here we're going to look at a retirement planning financial model. Now, surprisingly, there are a lot of similarities to building a financial model for any kind of business and for your own retirement. There's definitely some differences as well. So, we're going to get into populating various income generating activities and investments, as well as expenses, taxes. We're going to look at inflation, and this will show you kind of allow you to plan your cash flows over up to a 50-year period. Now, obviously, it could be less than that. Um, the summary tab will show a 10-year specific range. But let's just jump into it. And before actually, let's go to a disclaimer. Nor Smart Helping or Jason Varden is a financial advisor, and this model could contain errors used at your own risk. Now, let's we're going to walk through each tab, how it works, and show you the resulting summary that you'll get. So the control tab is first just to define your time range where the 50 year starts. And so you'll just enter the first day of the year you plan on doing these investments. It doesn't have to be the month, just the first month, first day of the year you plan on starting. So even if you're starting in, say, May of whatever, 2019, you still put 1/1/2019. Then we've got expected inflation rate over 50 years. Now, this is where things get tricky because, I mean, over the next 50 years, who knows what's going to happen? Right now, the Fed says they're targeting 2%, but maybe they won't. Inflation could change in a 5 to 10 year period. It could go up, it could go down, it could be negative, deflationary. It's hard to say. Now, you would look at the United States over the last, say, 100 years, and $1 100 years ago is obviously not worth $1 today. So it's inflationary in nature so far. It has been. Um, it depends on the current monetary system, how we move forward. There's all kinds of different things that could affect that. But this model will allow you to show what a dollar in 30 or 40 years from now might look like compared to its value today. And we'll get into it once we get into the model, the 50-year and monthly and annual model. But it's pretty interesting, and it'll show you kind of how if assuming your cash flow percentages don't change. But let's jump into that. So we've got our income here. So this is just saying this is mainly and this is why they say there's a difference between how long you expect these cash flows to last and if you should be in certain types of investments. This model is not going to look at appreciation of any assets for any purpose. It's simply looking at income generating investments only. And what income generating means is either dividend stocks that just send you a check every quarter or half year or however the schedule is. I think it's usually in the United States it's a quarterly, but it might not be in other countries. But you can just enter the annual dividend here, and it will put out the annual cash flow or income you expect to receive from the investment. So this is just S&P 500 dividend not reinvested. So right now it's about what inflation target is at 2%. Now that obviously could change over the future, but assuming you invest 500,000 in the S&P, you we don't account for any price movement up or down, assuming it stays flat forever. And that's just a general assumption to show just the effect of the dividend cash flow, and assuming you just hold it forever and you don't recognize any gains or losses from the principal. So let's say you put in 500,000, you could pick the month that the investment starts, and this is because you might not start investing in certain things until later, and so that can give you some interesting dynamics and cash flows. But right now we're just assuming everything starts on the first month, but that does not have to be the case. Like you can change this to any month over the course of 50 years. Now let's see here. Oh, I adjusted the annual model, monthly model, so the validation range has changed. Let me update that real quick. Okay, so there you go. This will be any month over the 50 years you can pick for any of these. And that's to show varying lengths of investment times. Uh, it's probably not the best model if you can't adjust that. So that's why that has been added. So you got your initial investment amount when you invest it, and then you've got your annual dividend or return on investment or whatever the distribution is. So S&P is obviously a dividend. You're saying you're not reinvesting it, so you just take that cash and put it in the bank for use for whatever you want. Fixed income bonds. So this is a little bit, the liquidity here could be an issue because it's not actually going to pay out every month or year. It might be a year and a half, but for the purpose of looking at an aggregate, you will obviously get that cash paid back to you eventually, and you can reinvest the principal only. In that case, we've just put a 5% in here. It's right now in this current market, this would be too, you're not going to find a 5% bond or I mean a 5% CD. You might find a bond. It just depends on your investment advisors and what connections you got. But uh, these are just examples. So we've got a bond here of 5%. Treasuries right now that's about 2%. If you do, it's about 2.3% annual right now. Um, and so this would mean you invested 300,000, you get a 2% yield. You take the 2% out when you close it out, and then you reinvest the same principal, and you just keep doing it, not reinvesting any of this. So it's not compounding. You're getting the cash right away. Uh, so there's that. There's a stock. So you might have some stocks, and you could have multiple stocks in here. You could have a stock portfolio that has some average yield, and you could put that into a row. But I just put stock XYZ with a dividend. You put 50 in. It's got a yield of this. Now the idea is with stocks, if the actual principal goes up and down, the yield will change accordingly. So if the price goes up, the dividend yield will actually go down because your stock's actually worth more. If your stock goes down, the yield will go up. For this purpose, we're just saying a given fixed amount and a given fixed annual yield to give this annual expected income from that investment. Then we've got another other investment. So this could be maybe you invest 100,000 in some kind of a business, or some kind of a cash flow generating business that will give you some percentage for the share over time. And then I did real estate because that's probably the next biggest thing that people will invest in for cash flow right now. And so based on that, you know, you get some yield and you'll get an annual amount. And you can go down the line here and just keep doing that logic. So you put in the description, the amount you're investing, the date of that investment, and what you think it will give you an annual return on an investment. Uh, then we have income tax here. So the reason why I put different percentages for each investment type is because the percentages might vary for each one. Now there's also all kinds of other factors, but I figured, if you're going to look at what your cash flow is likely to be, you want to take into account tax effects because that could be a major. If you don't take that into account, your cash flow is going to be different. Um, so that's there. So there's your income. So this allows you to figure out, what your top line looks like. So it's almost like in a business, this is your top line revenue. Then we have expenses. So this is pretty simple. You're just looking at all the different types of monthly expenses you plan on having, mortgage, car loan, food. I put in a reserve here for fun activities, vacations, these are all monthly amounts. Phone, cable, gas, just whatever you have to. Basically, this is what you have to be able to survive on. And so you can plan out how much that's going to cost. You can also adjust the start and end months. So I've also added an end month for these because it's more important for expenses that could vary a bit more than income as far as when they start and stop. Um, so you can adjust that here and it will dynamically flow to the monthly model. For example, so we got mortgage at 850 a month. We're starting in February of 19, ended in July of 32. So if you go to here, let's see, let me expand these. We've got, I don't want all these to be orange. You've got monthly expenses. Here's your mortgage, so you can see it's not starting. If we go back here, it's starting on February 19th. Now, if we change this to, let's say, oh my goodness, we also got to fix drop downs for this. Hold on. These were all targeting the annual. Let's just put the last month for these. This is why we review before we release, because fix things like this. So, um, we'll just have all these starting in January. But let's say we do change this to, um, say May of 19. So you could go over to the monthly and you can see, oh, mortgage doesn't start until May. So you got all these varying things with income and expenses, and it will aggregate over a fixed monthly timeline as then aggregate into an annual timeline. That's how the logic goes here. Uh, so you could enter all your expenses, the monthly amount of those expenses, and start and end month you expect those to happen. Then you can see we've got a monthly tab here, so this is just going to aggregate, your total you've invested, the total income generated per month on an investment. You've got some return on capital here, annualized amount. Here's your taxes for each type, your total taxes, your in cash flow after tax. Then you've got your expenses, and then you've got your cash flow after taxes and expense. So this theoretically is your cushion, or how much you should have left after you've paid for all your expenses and collected all your income for the month. And the reason why this is a monthly summary was done is because we have granularity on a monthly level for different certain times for investments and expenses and months. So we have to add that granularity before we can roll it up into an annual. Now also, if you look here in the top left, you can hit these to expand or collapse, so you don't have to see all the pieces and parts of the totals. You can just see the totals here if you want, which is a nice clean summary. Now let's go to the annual, and again, same deal here. You could expand it, collapse it. Now the annual is a little bit different. Here's what we've done. We've done this inflation adjustment. So let's assume, usually governments and currencies try to avoid hyperinflation, meaning, it's obviously not likely that the inflation rate is 2% every single year, and it exponentially grows. Now, to some extent, that might happen over a certain time period, but you also have months where you go down. So it's not realistic that it's just your inflation is going to go up 2% compounded every year. But this helps you plan if it did over time. So you can look at a 50-year scenario and say, okay, if the currency inflates 2% a year, which just means there's just more currency circulating, which means the amount of currency you have is now worth 2% less than what it was previously. And you'll see some of these complications we get into with this, but um, I guess let's start with the first year. So let's say you've got 41,000 you plan on making in the next year. But let's say if in the next 12 months the inflation rate was 2%, so that actually means your 41,000 is worth 2% less. So it's actually worth 41,024 instead of 41,438. You go to year two, same deal. You're just looking at the after-tax cash flow and reducing it by the amount of inflation compounded. Now, this is tricky because if you have more income starting later, like if you end up making these investments later on, then it kind of will adjust this inflation rate accordingly, but that's because it's just supposed to be an estimate. So in general, you can see if you start with the same if you have the same cash flow, you expect the same fixed income for the next 50 years. If the inflation rate were 1%, then in 50 years it should be worth about half, which you can see over here. Go 50 years over, it's now about almost, is that exactly half? I think it is, times 2. Yeah, it is. So that's the effect, and the reason why I've done it like that is because the other way you could do it is you could say, well, my expenses are going to go up by X, and my income might go up by Y. We're not doing that. We're doing a bit of a different style, which I think is more fair. Is just we're going to say the expenses stay the same, but the income has less buying power. So in all reality, all inflation will mean is that, the expenses could go up, and if you have the same amount of income or same amount of dollar amount of buying power, um, you would be able to purchase less. So this is representing the same logic, but it's just working backwards and saying your income is actually worth about half here, expenses stay the same. Saying the same, both explanations work. It's just saying your money is worth less in the future if inflation happens. Now it is possible for deflation to happen, meaning the money you get is worth more now, or I mean is worth more in the future because there's less circulating supply. So some other things to think about. This also obviously assumes that the S&P dividend does not change. It assumes these percentages don't change, and you're not going to get any higher of a rate for your investments. And I mean, there's a million different ways you could try to model this, and a million different things you can take into account. I tried to make it as simple as possible and show some scenarios. So if we go over to the summary, you can see the monthly cash flow after taxes and expenses. You're looking at, about $400 a month. And if we put this back to January, it actually, you can see it all be level. Um, about $425 a month. And then you can see the annual here, about 5,000 a year in free cash flow. And on here is the interesting part. So it is the inflation adjusted annual cash flow after taxes. So this is now saying you will have negative after 50 years if these percentages, if you never reinvest any of this and the face amount of all these investments, if they never change, then you'll basically have enough to survive. You'll have enough free cash flow to make it to, what is this, a year, about 2028, almost 10 years. And if you just go to the annual, you can easily see you make it to year 12, and then after that, the inflation adjusted dollar amount actually drops below your planned expenses. You see here your planned inflation adjusted cash flow is about 36.4. Your planned expenses are 36.3. That's about zero. Here you can see it actually goes negative. So that's probably the most interesting thing is if you're a retirement and you want to see how much your money will last, given that expenses likely will rise in the future, and if you keep making the same amount, you want to know kind of where you're at. And then at that point, you would obviously have to start dipping into your investments to go off of. So I think this is a good conservative way to look at your retirement and kind of judge, how long you have how long you can live off of a certain dollar amount, and if you can live off of even if you look at the near term where inflation has not a lot of effect, you can still see, will you have enough cash flow to cover your planned expenses? So I think this is simple enough for the layperson to use and just see. And I say that because we have just the general cash flows that don't take into effect anything. You just say, if you make this, your expenses are this. Um, Here's what you have left over, if anything. It gets more sophisticated with the inflation adjustment. Um, but again, there's lots of errors in that. I mean, there's not errors, but there's lots of ways to interpret that, and you could change it. It's just, I think it's interesting to think about that as well. And let's say you think inflation maybe is only 0.5%. You see how that changes that now you've got until about, an extra 15 years or so that should cover all your expenses. All right, well, that's all I got. If you want to purchase this model, you can just go to smarthelping.com. It will be the latest, well, obviously in the future. It's not going to be the first one, but you can search for it under financial models at the top right here. And I'll probably have this under um, general business models and tools. Also, it will be in the description box below in this YouTube video, so you can just click right through to the link. And the cost for this, I just charge a one-time fee of $45, and you can have this fully unlocked, and you can edit it however you want. I think it is a useful tool. All right, have a great day.